Hello everyone, Walter Dillard here from Dillard Life. Today, once again, walking and talking. And today's topic is about the different types of life insurance and the right financial plan for you. So at the end of the day, life insurance comes in a wide variety of forms. Let's be honest, at the end of the day, there are so many different forms of insurance out there. But let's keep it simple here. At the end of the day, there are basically two main types of life insurance. You have term life and you have whole life. I know, not really that complicated, right? Term life is only fixed for a certain term, versus whole life is going to be something that is going to pay out for your whole life. So your family is guaranteed a benefit, and you can even get a cash value on that paid back to you personally if you live long enough. The age for that used to be if you live to age 100, you get the life insurance matures, payout there. But nowadays they've made that a little bit older, so because a lot of people now have extended their lives to age 100 versus when life insurance was first invented. It's also the card you get in Monopoly for all of those big Monopoly fans out there. When it comes to Monopoly, it's very much the situation. Like everybody gets the life insurance matures card. Guys has like the long beard. Collect $100. Anybody else huge Monopoly fan? Whatever. Anyway, so when it comes down to it, you have these two main types of life insurance. So term insurance is mostly just about protecting you for a certain fixed period of time. So basically, you want term insurance for the next, say, 10 years, 20 years, 30 years, 40 years, etc. So basically, if you died during that period, then the insurance is going to pay out to your family a fixed amount. The end. Pretty simple. At the same time, you also have whole life policies, which are going to pay out no matter what at the point of your death. So they are permanent insurance, okay? So that's really very much the two types of policies. Why is this important? Because everybody has a different financial plan. That's why. So if your plan is to mainly invest your money, somebody like me personally, who invests a lot of money and focuses on building a large asset column, then what you generally want is going to be term insurance. You want term insurance as a hedge against you dying too soon. So that basically, if you were planning to, have a huge asset column by age 65 and you were to pass away at age 40, for example, then the huge amount that's paid out by the insurance company is basically substituting for the assets you would have invested to your family, properly if you had lived to age 65 because you passed away 25 years too early. So term insurance is a good hedge against the worst case scenario. Personally is the way I recommend people go because it's like, at the end of the day, I run a finance company. I focus on that. I focus on investing well and building a large asset column, as I know many of you guys do. And at the end of the day, to me, it's just a good hedge against the worst case scenario. Versus whole life is more of an investment to some extent. And in that situation, you're looking to basically say, I want to build cash value in this policy. I want it to grow properly. And I want ultimately my family to be a guaranteed payout, So often this is going to be a good policy if you're a little bit older and you want to have a good policy in place so you know that your family is going to get something. But it's also a case where, of course, the policy is more expensive because it's a guaranteed payout. So it's more expensive for the insurance company. At the end of the day, as I said, my main focus tends to be, and this is just personally being me, somebody who's still in my 20s and all, my focus is on term life, where it is a hedge while you also invest a lot of the money that otherwise you would be putting into a whole life policy. This is definitely what I recommend to the young and healthy. It's good to have a cheap term life policy with the right group because many different insurance companies are going to charge you many different rates. But to have a good one with the right insurance company that is going to allow you to properly hedge while your investments are going to build value. So by the time the term is going to expire, it's also the point when your assets have grown to the right value so that then that is going to be the nest egg to leave to the family. Personally, that's the way I recommend things go. But of course, everybody is different and every financial plan is different. That's the important thing. Anyway, I'll see you guys in the next video. Cheers to ya.